How does a 29-year-old billionaire lose $8 billion, leaving investors shattered and his empire in ruins? Welcome to Business for People in a Hurry. Today, we're diving into Going Infinite, the riveting story of Sam Bankman-Fried's rise and fall, a cautionary tale about ambition, greed, and the fragile foundations of modern finance. The central figure in the saga? Sam Bankman-Fried, a man who, in just 3 years, went from an unknown to a billionaire at the helm of FTX, one of the world's largest crypto exchanges, before losing it all in a scandal so massive it left a financial crater. Picture this, it's 2021. FTX is at its peak, valued at $32 billion, and positioned as the third largest cryptocurrency exchange in the US. Behind the scenes, though, Sam remains a mystery. He's 29 years old, disheveled, and spends more time coding in a t-shirt than rubbing elbows with Wall Street elites. Yet, he's somehow built an empire in record time. The world is asking, is he a visionary genius or a ticking time bomb? This is where Michael Lewis steps in. You know Lewis as the mind behind The Big Short and Moneyball, a master storyteller who uncovers the hidden cracks in seemingly unshakable systems. When Lewis's friend, the head of a major stock exchange, asks him to investigate Sam, Lewis agrees, shadowing him for 10 days. What he uncovers is fascinating. Sam's life was far from ordinary, sleeping in his office, surviving on veggie burritos, and obsessively working. For him, money wasn't the goal, it was just the fuel for his grander ambitions. He talks about effective altruism, his philosophy of accumulating as much wealth as possible to do the most good in the world. It's a compelling narrative, one that even sways Michael Lewis. But as Lewis digs deeper, he notices troubling inconsistencies. How did someone so young, with no significant track record, create such an enormous financial empire so quickly? And why does the story feel just a little too good to be true? The bombshell hit in November 2022, $8 billion in customer funds had vanished from FTX. Let that sink in, $8 billion, not misplaced, but gone. Within days, FTX collapses, taking with it investors, firms, and the hopes of countless individuals who believed in Sam's vision. What follows is one of the largest financial scandals in history. Federal prosecutors call it a textbook case of fraud, and Sam, once heralded as the future of finance, is now facing decades behind bars. What makes Going Infinite so powerful isn't just the retelling of these events. It's the way Michael Lewis dissects the psychology, the ambition, and the systems that allowed this disaster to unfold. This isn't just Sam Bankman-Fried's story. It's a cautionary tale about unchecked ambition, greed, and the fragility of systems built on hype instead of substance. Over the next segments, we'll unpack the story in 3 parts. First, we'll look at Sam's meteoric rise, how he built a crypto empire seemingly out of nowhere. Next, we'll explore the allure of the cryptocurrency market, a world where fortunes are made and lost in the blink of an eye. Finally, we'll dissect FTX's collapse, exposing the cracks that brought the entire house of cards tumbling down and the lessons the financial world desperately needs to learn. This isn't just about Sam Bankman-Fried or cryptocurrency. It's a story of ambition unchecked, systems built on fragile foundations, and the high-stakes gamble of chasing infinite growth. Let's dive in. Let's kick off with a question. When you hear the term financial elite, what comes to mind? Is it Warren Buffett's calm authority? Ray Dalio delivering profound insights at summits? Or maybe it's the image of someone in a sharp suit, juggling market risks while keeping an eye on global politics. That's the stereotype. But Sam Bankman-Fried? He shatters every piece of that mold. Here's the deal. Sam was a math genius. High school math Olympiads? Crushed. Dual degrees in mathematics and physics from MIT? Check. His raw intellect was off the charts. But that's where his similarities with traditional financial titans ended. Sam was socially awkward. He even avoided handshakes. His wardrobe? 2 t-shirts. His hygiene? Let's just say his greasy curls did all the talking. And his passion? Not finance, video games. The kind you play for 10 hours straight, forgetting meals, the world, everything. So, how does someone like that an introverted gamer with no interest in money, end up founding a $32 billion cryptocurrency empire. Michael Lewis, in Going Infinite, points to two key forces: philosophy and timing. First, the philosophy, effective altruism. Stay with me, this part's big. It's a high-minded idea from Oxford philosophers. The gist? If you're smart, you have a moral obligation to fix the world. But here's the twist. It's not just about being generous. It's about being strategic. Don't just volunteer or toss spare change into a jar. Use your unique skills to make a fortune. Then funnel that money into causes that could reshape humanity. Think global vaccination drives or eradicating poverty. Even Facebook's co-founder Dustin Moskovitz is on board. Sam bought into this philosophy completely. He saw himself as its golden child, destined to tackle global inequality. This mindset gave him a moral excuse to chase unimaginable wealth because, hey, he'd donate it later. But it also fed into something deeper, his sense of superiority. Growing up in a $3 million Palo Alto mansion, surrounded by Stanford professors, Sam saw most of his peers as unimpressive. Effective altruism? It was the perfect justification for aiming higher than anyone else. But ambition isn't enough. Timing matters too. By the 2010s, America's top STEM grads were flocking to Wall Street. If you were good at math and kept your cool, you didn't need to know stocks or markets. Finance firms wanted speed, precision, and algorithms. Sam followed the trend, landing an internship at Jane Street Capital, a high-frequency trading firm. Let me break down high-frequency trading, or HFT, for you. Imagine someone wants 1,000 shares of a stock. The shares are spread across 20 exchanges at slightly different prices. HFT firms step in, buy those shares in milliseconds, and resell them for a profit. It's all about speed. Jane Street was one of the top players, moving $4 trillion a year. Sam thrived there. He traded index funds, fine-tuned algorithms, and soaked up the financial world like a sponge. But it wasn't just the work, it was how finance mirrored his love for gaming. Trading was just another game to him. He even used sandwiches as a metaphor. If a sandwich's ingredients cost more than a sandwich itself, you buy the sandwich and sell the ingredients. If it's the reverse, you flip it. Simple, efficient, and, for Sam, wildly profitable. Jane Street taught Sam two critical lessons. 1. Booming industries tolerate quirks. It wasn't your typical buttoned-up Wall Street firm. It was a haven for brilliant misfits. That worked for Sam. 2. Finance didn't demand accountability. Algorithms handled most of the work, and traders often reviewed results weeks later. Sam exploited this, reverse engineering competitors' algorithms and turning their slip-ups into his wins. By the time he graduated in 2014, he was a rising star at Jane Street. Fast forward to 2017. Sam is 25, pulling in over $1 million a year, and already donating chunks of it to charity. By most standards, he's living the dream. But not Sam. Wall Street's game felt too small. He wanted something bigger, faster, something infinite. That's when he turned his sights to cryptocurrency, the wild west of finance. Next up, we'll unravel how Sam broke into crypto, built a billion-dollar empire, and attracted investors in droves. And, of course, we'll dive into the cracks that brought it all crashing down. Stay tuned. This story is about to shift into high gear. So, how does a video game-loving math geek transform into the crypto king practically overnight? The answer lies in a mix of ambition, timing, and just the right dose of chaos. By 2017, Sam Bankman-Fried had had enough of Wall Street. The strict systems of high-frequency trading at Jane Street felt too confining for someone aiming to play on a grander stage. Enter cryptocurrency, the wild west of finance. A $760 billion market with rules so loose they might as well not exist. Traditional banks kept their distance, wary of volatility and unclear regulations, while early adopters scrambled to figure out how to turn a profit. For someone like Sam, who excelled at spotting inefficiencies, this was a goldmine waiting to be tapped. Here's what Sam realized. Crypto wasn't about understanding businesses or fundamentals. It was about finding gaps, inefficiencies, and opportunities. To him, it was all just a game, and in this game, he intended to write the rules. In November 2017, Sam launched Alameda Research, a crypto trading firm, with $500,000 from his savings. His pitch? Simple math. The crypto market was riddled with inefficiencies. If Alameda could capture just 5% of global crypto trades, they could rake in $300 million a year. With that kind of money, Sam could fund his dream of effective altruism, using his wealth to change the world. It was a compelling vision, and it worked. He convinced 20 idealistic, fresh-out-of-college recruits to join him. His team wasn't your typical Wall Street ensemble. No suits, no seasoned veterans, just raw ambition and talent. So, how did they pull it off or stumble along the way? Alameda's early success wasn't driven by cutting-edge algorithms, despite what they claimed. Instead, they made money through arbitrage, taking advantage of price differences across markets. The most famous example? The kimchi premium. In South Korea, Bitcoin was trading 20% higher than in the US. Sam devised a system to exploit this gap. Step 1. Sell Bitcoin in South Korea for Korean won. Step 2. Use that one to buy Ripple, XRP, which also had a premium there. Step 3. Transfer the Ripple back to US markets, sell it for dollars, and repeat. Each loop took 30 seconds and netted a 5% profit. Over time, those tiny margins added up to millions. Clever, right? But there were major problems. First, South Korea's market had strict regulations. Only citizens could open accounts, and currency transfers were tightly controlled. Sam found workarounds, but they weren't sustainable. Worse, Alameda's tech wasn't foolproof. In one costly mistake, they sent $4 million worth of Ripple to a South Korean exchange, only to find out it didn't support Ripple transactions. 2 months later, they got the money back, but just barely. In the chaotic world of crypto, where everyone was improvising, these missteps went largely unnoticed. By 2019, it was clear that arbitrage alone wouldn't sustain them. The market was evolving, and competition was closing the gaps they once exploited. So, Sam pivoted. This is where things got really interesting. He launched FTX, a cryptocurrency exchange. The concept? A one-stop shop for crypto traders. But the real strategy was about control. Unlike traditional brokers, FTX operated with minimal oversight. Sam could act as both a trader and a custodian, holding customer funds while also making trades. It was a conflict of interest baked into the very structure of the platform. Investors didn't see the flaws. They saw a chance to cash in on the booming crypto market. During FTX's Series B funding round, the company raised $900 million from heavyweights like SoftBank and Sequoia. With that backing, Sam's star rose even higher. FTX became a powerhouse. By 2022, it was valued at $32 billion, generating over $1 billion in annual revenue. Sam himself was hailed as crypto's golden boy. Forbes estimated his net worth at $15 billion, placing him among the richest Americans at just 30 years old. Sam was everywhere, speaking at Davos, mentoring startups, donating millions to political campaigns on both sides of the aisle. To the world, he wasn't just the founder of FTX, he was the face of cryptocurrency. The next Warren Buffett, some called him. But as we'll soon uncover, the empire he built wasn't just fragile, it was doomed to collapse. Next, we'll dig into how FTX's rapid rise masked deep structural flaws and how the very ambition that propelled Sam to greatness ultimately led to his downfall. You won't want to miss this. And now we arrive at the final act in the saga of Sam Bankman-Fried, the moment where ambition collides with hubris and his empire crumbles into ruins. Strap in, because this is where the dream of infinite wealth crashes headfirst into reality. Here's a question. Did Sam's relentless quest for wealth ever deliver on the promises of effective altruism? The short answer? Not really. In 2018, Alameda Research reported $30 million in profits. Sounds impressive, right? But let's dig deeper. Half of that went straight to investors. Another $5 million covered operational costs. Then came severance packages, taxes, and what was left? Just $1.5 million, barely 5%, set aside for charity. Sure, $1.5 million isn't small change, but it's a far cry from the world-changing philanthropy Sam constantly championed. Even as a billionaire, Sam's track record for giving didn't live up to the hype. He claimed to have donated $160 million, but here's the catch: his personal spending painted a different picture. He dropped $32 million on a mansion for his parents, $35 million on a corporate retreat in the Bahamas, and $15 million annually on private jet rentals. Effective altruism? By this point, it seemed less like a guiding philosophy and more like a shiny marketing tool to distract from his extravagance. And that scrappy, socially awkward genius persona? Turns out it was just another act. Court testimony revealed that his greasy hair, ratty t-shirts, and chaotic sleeping habits were all part of a carefully crafted image. He even played video games during investor meetings. Normally, that kind of behavior might raise eyebrows, but in the tech world, eccentricity is celebrated. Investors didn't see warning signs, they saw genius. They were so enamored with the myth of the quirky visionary, they overlooked the cracks forming right under their noses. And those cracks? They were massive. Let's talk about the cryptocurrency market, the volatile, speculative machine on which Sam built his empire. Unlike traditional finance, crypto has no intrinsic value, no safety nets. It's pure speculation, and for a while, Sam played the game better than anyone until he didn't. Here's the ugly truth. Sam was using FTX customer funds, $10 billion of them, to cover Alameda Research's losses. To keep the illusion alive, he used FTX's own tokens as collateral. It was a house of cards, and when the market lost confidence in those tokens, the whole structure collapsed. In November 2022, panic spread like wildfire, triggering a massive run on FTX. Within days, the company was bankrupt. That $16 billion valuation? It was nothing more than smoke and mirrors. The fallout was devastating. Creditors scrambled to recover what they could, but the damage was done. And Sam? His meteoric rise ended in disgrace. By March 2024, he stood convicted of fraud, money laundering, and a host of other charges. The sentence? 25 years in prison. From MIT to the Forbes billionaires list to a prison cell, all in less than a decade. So, here we are at the end of Going Infinite, a story that feels almost too surreal to believe. It's a tale of ambition, hubris, and the relentless pursuit of something that isn't even real. And that's where Michael Lewis leaves us, quoting the legendary mathematician David Hilbert, "Infinity does not exist in reality. No experience, observation, or knowledge can make it real." Let that sink in for a moment. Sam Bankman-Fried wasn't just chasing wealth, he was chasing infinity. An endless loop of more. More money, more power, more recognition. He told himself it was all for the greater good, that every dollar he made would save lives one day. But in the end, what did he save? Not FTX, not Alameda, not even his own reputation. But this story isn't just about Sam. It's about the systems that let him rise to the top of a fragile empire unchecked. It's about the culture that idolizes the disruptor, the eccentric genius who breaks the rules until they break everything else. It's about the investors, the media, the regulators who bought into the myth without asking enough questions. And maybe it's about us too. Because Sam's rise and fall forces us to confront a question we'd rather avoid: what are we chasing and why? Sam's story is a cautionary tale, but it's also a mirror. Are we pursuing goals that truly matter, or are we just running endlessly on a treadmill, chasing something we can never grasp? Are we prepared to face the consequences of our ambition, or are we hoping someone else will clean up the mess when it all falls apart? Here's the takeaway. Infinity might be a beautiful idea, but it's not real. What's real are the choices we make, the people we affect, and the values we hold when no one's watching. Maybe the true lesson of Going Infinite is this: the things that matter most aren't infinite, they're finite. And that's exactly what makes them so precious. Thank you for exploring this story with me. If it struck a chord, Share it with someone who needs to hear it. Don't forget to like, subscribe, and comment. Let's keep the conversation going. Let's keep questioning. And let's make sure that in our pursuit of greatness, we don't lose sight of what's real. Until next time, take care.